Wednesday, July 13th, 2022, Maneco 64, home of alternative economics and contrarian views. Yes, we're still here in Italy. We're leaving tomorrow. We're driving back to Milan in the morning. We're going to spend the afternoon in Milan, and our plane leaves early evening back to London. But yeah, today we're going to look at how every time this indicator pops up, the Federal Reserve stops its tightening cycles, and that's happened every time in the last 30 years. And yeah, we're going to look at that today. Before we do that, just a few things I wanted to talk about. Today, of course, there's the CPI number. Many people think that's the inflation number, and most of you know already what this means, right? The CPI is the Consumer Price Index. It's a measure of how consumer prices have done in the last month, in the last year. So it measures prices, and rising prices are just a reflection of a depreciating currency. And how does a currency depreciate? Well, the monetary authorities and government, they create that currency out of thin air. They borrow it into existence, governments, on the back of your efforts, because the more they issue, the more they have to tax you, unless they really want to let that currency go down the drain. And I have a feeling that they won't be able to tax you enough to do that. So it's a simple law of supply and demand. It's akin to, let's say, IBM making a rights issue and issuing more shares. That dilutes the existing shares, the value, and that's all it is. Under a sound money free market system where people use gold and silver, or they could use whatever they want. The reason why I talk about gold and silver is that it's been chosen as money for the last few thousand years. It's harder to really create gold and silver out of thin air, right? So the currency doesn't dilute as badly. It's relatively stable. Nothing's perfect, of course. There was during the I think 16th century, maybe early 17th century, when the Spanish conquered the New World, most of South America, Central America, they pillaged the locals. They got a lot of silver out of there through slave labor, or through taking the silver that was already being used there, or as, you know, and they brought a lot of silver back into Europe, and that created that was an inflation. It was an unusual supply of the money, and it created rising prices in Spain. So I'm not saying gold and silver are always, you know, that can happen, but it was a very unusual event. It was something that came out of the blue. They discovered the New World. There was a lot of silver there, of course. So yeah, why am I talking about that? Well, because yeah, we've got the CPI today, but the inflation, of course, has been created already. Not just since '08, even before '08, but it's gotten worse since '08 with all the QE. It's gotten worse since 2020 with all the QE in March. And all we're experiencing now, and I think von Mises and the Austrians said that, the creation of currency and credit out of thin air doesn't necessarily create higher consumer prices right away, because of the Cantillon effect, and it hasn't been for until the last 2 years that we've seen this currency flow into all the things that we need to survive on, all the basic necessities, commodities, Prior to that, it was flowing into real estate, the NASDAQ, bonds, and now it's flowing out of that. And commodities is a small space compared to the paper assets. So if you have investors and fund managers trying to protect their portfolios, they might not switch even 10 or 15 or 20% of their assets into commodities. They might do 2 or 5%, and just that amount alone will make it's like putting the Niagara Falls into a hose, right? And that's why commodities, that's why I've been talking about commodities becoming so important in the next few years, maybe even decade. So yeah, the story here, I hadn't seen that. U.S. Bureau of Labor Statistics says leaked 10.2 CPI report was fake. So what's expected then? According to investing.com, CPI is expected to rise in June year on year from 8.6 in May to 8.8. That's the expectation, 8.8. The Fed, of course, seeing that the people who work there don't have to go shopping for food and energy. They got chauffeurs and maids or whatever. They look at the core CPI, which excludes all the basic necessities of life, all the things that are going up, or that the dollar is going down against. And why do they do that? Well, because they use this excuse that they're volatile. So the core number is expected to drop from 6% to 5.7. So that's what's out there today. It's going to be an important number. And I wanted to talk a little bit about silver before I go into this indicator that I spoke about at the beginning of the video. There's a lot of you that, of course, are frustrated about the paper price of silver. I see some comments that some people say, "Oh, silver's finished. Silver, you said silver was going to make me rich." I never said that. Someone said, "Oh, you said if I had 100 ounces, I'd be doing really well." Well, I haven't sold my silver. The thing about silver is that it's money. And if you go back, or if you look at different languages in different countries, the name for the word for money is silver. And coming here to Italy, I brought a few silver coins because I wanted to talk to people, because Edward has introduced me to a lot of people, and I've spoken to them about what's going on. And one of the guys here, he's Austrian. We were talking. He's done a few lectures, and yeah, I didn't say anything. He said, "Well, I'm putting my money in gold and silver." So yeah, but I wanted to show you a few coins then that I brought, only to illustrate that it doesn't matter where you are. Silver has been money. So I got here a 1964 half dollar, right? 90% silver. I've got here 1,000 reais, which is, you probably never heard of this. It's from 1863. It's a Brazilian silver coin. There you go. Pretty much the same size actually as the half dollar. Then I've got a 1963 2 Swiss francs. I think the Swiss, they went off the silver coinage in 1968, 67. If you got any Swiss francs from 67, don't spend it, or don't get rid of it. It's silver. So there you go, silver. And then we've got a 1915 florin, which is British sterling 925. The British, they took out 50% of the silver in 1920 after World War I, and then in about after World War II in 1947, they took all the silver out. So they went off silver a lot earlier than let's say the US or Switzerland, or there are a lot of European countries that were on the silver coinage until the late 60s. And it's interesting because I'm learning here that the Catholic Church changed a lot around the same time in the 60s. They stopped conducting the mass in Latin around the same time, which is strange, isn't it? And the thing about money, I was talking to Edward about it, is that it's half of all human commercial transactions. And if you make the money bad, i.e. there's no standard to it, it's not surprising that standards and moral standards, or all kinds of standards in society, dilute as well. So just wanted to touch upon that. So now to this indicator. And I've spoken about this recently because it's a canary in the coal mine, so to speak. So this is Tavi Costa, who we've had a few times on the channel, of course. Hopefully I'll get him back again. And he posted this out yesterday, and he says in the last 30 plus years, every time the yield curve inverted, the Fed was forced to end its tightening cycle. Here we go again today. US yield curve versus prior tightening cycle. So you can see here, yeah, I mean, it's very clear. Every time that happens, the Fed funds, the tightening cycle stops. And if you notice here, since the mid 80s, the peak of the tightening cycles, they've all gone down. So we had lower lows, and it's not surprising that this time it will probably be the same, unless they want to end, I guess, or bring the whole system down. And if they do that, it will be very deflationary, I agree. But in a deflationary collapse, a lot of banks, a lot of businesses, a lot of countries, governments will go bankrupt. So if you are a creditor to those institutions, you're going to be in trouble if you're in the system. So that's what you have to think about, even in a deflationary collapse like we had in the 1930s. If you had money outside the system, i.e. gold and silver, you would have been okay. And yes, that value, the value of that nominal value of that gold and silver might not do much in terms of fiat prices, but they will hugely outperform in relative terms all the assets that have gone under. Of course, they will go to zero. Gold and silver will never go to zero. So that's what I wanted to show you. And with that, we can quickly look at the markets. It's very early. I got up early because my video from yesterday was by the pool at 2 p.m. The cicadas are really active at that time. Right now they're quiet, and also there's no one around, no one down at breakfast. I apologize if some people thought that was a little bit, yeah, that the noise. But I thought as well that it would be good for you to see what it is like here. So yeah, it's just before 7 a.m. Italian time, which would be 6 a.m. back in London, or yeah, 1 a.m. Eastern time in the US. So we're quite early. Where we got spot gold, 17.25. It's down about $1. High's been 29, low 22. Silver is up 2 cents at 18.94. High's been 19.02 and the low 18.85. The Dow futures up 25, Nasdaq up 24, S&P up 4 points. Got the FTSE down 16 and the Euro Stoxx 50 down 14. The currencies, sterling is up 1/8%, 119.02. Euro is unchanged, just above 1, 100.35. The low has been 100.22. So the euro's holding that 1% level, one level. Sorry. The dollar's well, the yen is continuing to flounder. Dollar's at 137.04. Dollar is down slightly versus the Swiss franc, 98.20. And the ruble, not the ruble, sorry, the yuan, the dollar is down slightly at 6.73. Quick look at the ruble. Yeah, the ruble is gone back up, or the dollar's gone back down. We're now at 59. I think late last week and up until earlier this week we were above 60. I think we even got up to 66, and I think that was in reaction to the commodity prices and oil falling. And oil I saw had a big drop yesterday, but it looks like the ruble has stabilized for now. We'll quickly go to the general commodities. I won't do the other currencies. It's not anything personal, but it's because I want to get this done before we go for breakfast. Yeah, we got WTI crude at 93.55. That's unchanged. Brent's unchanged as well at 97.72. High-grade copper is down 1/3%, 327, and U.S. nat gas is up 2% at 622. We're going to look at the U.S. Treasury yield curve. So the 10-year yield is up just over 1 basis point at 2.97%, and the 2-year yield is at 3.05. So yeah, we inverted by about 8 basis points. I think yesterday it was about 10. Every time this happens, the Fed has to stop the tightening. I think they will tighten this month. I think their meeting is starts on the 25th, ends on the 26th. They're going to probably tighten another 75. We'll have to see also what the CPI does. I know the CPI is just like looking at inflation in the wing mirror, right? Because inflation's been created already. This is just a consequence of it. Be as it may, though, I think if it's a lower than expected number, especially the headline number, the markets might price in less tightening, i.e. about 50 basis points in about, 10 days or so, or a couple of weeks. We'll have to see. So yeah, if you enjoyed this video, make sure you hit the like button. Please share far and wide, and think about subscribing to this channel if you haven't yet. Yes, and I wish you all a great day. Take care. Bye.